I'm Jeffrey Ong from Titanium Synergy. Today I'm going to talk about the contents of my property value investing course. As you know, in the first video I talked about us doing a collaboration with Piranha Profits, which is called Property Value Investing Course, and it teaches you how to use certain strategy that you can multiply the number of properties and that you can potentially retire within 10 years to own 10 properties. It is very possible. And I've achieved it, and I've achieved in times like some of the properties I have no money left behind, and these are the secrets that will be unlocked. And of course your returns will have been 15 to 50% per year. So what are you going to learn? The B4R strategy, which is buy, refurb, rent, refinance and recycle. This body of knowledge has been around for many years, from Australia to New Zealand to US and UK. Unfortunately, it's hardly practiced here, although I know a few people who do that with landed properties, and when I say here, it's Singapore. The course will teach you to calculate the intrinsic value of a property and profit at the point of purchase. I teach you the proper valuation technique, whether it's commercial or residential. So you come up with a theoretical price that's very similar to what Piranha Profits teaches for stocks. Once you know what the fair value of a property is, you will aim to buy below market value so that you can earn that profit. And the difference between property and stocks, again, which I didn't mention actually at the start of the previous video, was that properties are not similar. It's not like stocks where you buy Amazon and then one price, you can't get it at any other price for that moment. For property, they are heterogeneous. Just across the street, something can be 500,000, and then next to it, you could buy at 420 because it's different. The build is different, the condition is different, the facing might be slightly different. There are different stories behind that property. So number 3, to avoid common mistakes in property investing, a lot of Asians, a lot of novice property investors, once they go outside their own countries, they've forgot what to look at, what are websites to look at to do a simple comparable analysis. For example, in UK, it could be Rightmove to see that in that postcode whether you're buying at a good price. And in US, it could be Zillow, Singapore is Property Guru. So these are the basic stuff that will teach you how to do a comparable, that you know that you're not overpaying for it. We will guide you how to finance your purchase with minimal cash, unlock the value and force capital appreciation. And certain asset classes you can really force capital appreciation. This is another difference between real estate investing and stocks. The course will drill down into the 4 factors in the B4R. First is to buy. What to buy? Commercial shops, office, industrial or residential. What asset classes gives you the best returns and how do they behave? For example, do you know that commercial properties, once there's no rental income, there's no tenant, and an empty commercial property, the value could plunge to 50% or even could be valued at cost. Whereas when you put in a tenant, the quality of tenant matters, and it becomes a function of income, just like a PE ratio. So it is very different from residential, where you can use comparable analysis for it. So where to buy? Singapore, UK, US, Malaysia, New Zealand, Australia. Let me give you one tip. Similar to the first video I talked about, if you can't get a mortgage, then don't buy it. Buy the ETF, buy the stock. That's my advice to you. Forget about the volatility. It's a lot more hassle-free. But property, the extra returns and the low risk come from when you can get a mortgage. So forget about a lot of countries that don't give you mortgage. Which city within that country, once you have identified that country, what are the cities that are actually suitable for investing? And within the city, it could be huge. There's so many suburbs, so where do you go to? Finally, I'll teach you how to analyze the demand and supply statistics so that you know the property price will go. And a lot of industry practitioners tell you demand is going to be great because there's going to be infrastructure spending, a lot of building, jobs are coming, but do you know why houses all over the world are appreciating faster? Just like Singapore, maybe they're appreciating at 10 to 12% return per year versus apartments at 5% per year. That's because of supply. Apartments have unlimited supply because the sky's the limit, whereas land, you ain't making it anymore. That's why you're subdividing it smaller and smaller. So supply is very important. I'll teach you a couple of things, but let me tell you one trick. It's called the crane theory. Crane theory is when you go into the city, if you see there are lots of cranes building tall buildings, you know there's going to be a lot of supply in that area. And the cranes, if they have been around for 2 to 3 years, one here, one there, and then the buildings are about to be completed, I think you should stay away from the city, that area at least, because you'll be fighting with a lot of new builds, a lot of completed apartments. Refurb. In the picture on the left is totally untenantable before refurb. On the right is a beautiful house suitable for a family to live in. So houses is where you can force capital appreciation. I know you think that a house is very expensive in Singapore. Yes, but do you know outside of Singapore, houses are a lot cheaper. Malaysia, you could get it as cheap as, say, 500,000 to 1 million ringgit. That's only about 300,000 Sing dollars, right? And that's probably about 250,000 US. So in this example, I purchased a property for $200,000 in January 2023. I could accurately estimate the refurbishment cost of $75,000. The cost will tell you how to get the expenses roughly so that you will not go overrun. Gross development cost is $275,000. 6 months to a year later, bring it back to a bank for revaluation. Bank revaluation, $350,000 in December 2023. The course will teach you how to accurately estimate the bank revaluation. And there are many ways to do it so that there will be less mistakes of getting an undervaluation. In this case, a profit is $75,000. Percentage profit is 27.3%. Rental appraisal. Before that, it is untenantable. After that, $1,750. The course teaches you simple things like how to estimate the rental income of this property and accurately drill down on the costs. The gross yield in this case is 7.6%. So refinance 12 months later, that's December 2023. Bank revaluation $350,000. Loan to value ratio 75%. The mortgage is $262,500. An interest of 5.5%, which is $14,375. Yes, in many countries, interest-only loan is available, and that's the best. It doesn't make sense to pay down your loan because inflation will push up the price of your assets, but you will destroy the value of your loan. Think about it. 30 years ago, how much was a Big Mac? Probably $2. And now, it's probably worth over $6, $5 to $6, right? So it's pushed up the price of almost everything, okay? But the debt remains the same and it becomes less and less valued after many years because it's still the same. So inflation has destroyed the value of debt. So net rents is $21,000 minus maintenance costs, minus management fee, which is you need a property manager to manage it, which is about 12%. Maintenance is probably 5%, and then the void cost is about 5% as well, so it's 2,100 and it is 16,380. Now going back to the interest only, let me tell you another thing. Many people believe that, and my parents think so, like not paying off the debt, not paying it off is very dangerous. But if you try to pay it off in a short period of time, the mortgage stress on you is great, man. Think about it. If you try to pay off your debt, principal plus interest over, say, 15 years, you're going to end up paying with a mortgage liability of 30 over 1,000 in this case per year, right? What if you lose your job? you will definitely default, or there's a late payment, it goes into your record, and then it affects your credit bureau credit scores. So if you smooth out your payment over a long time, or best still have interest only payments, the stress on you when there are times where you lose your tenants, or there are times where there are voids, there are times where rental market goes down, you know, at least the liability on you for every month is very little. So the chances of you going default is a lot less. So to me, it is safer to have to stretch your loan payment over a long time than the short time. In fact, interest only is the safest. Now, then what about the principal? Well, if you have a lot of capital appreciation, you can refinance it, or you don't refinance it, or if you have a lot of savings, you could just pay down the debt after the fixed rate is over. So it's in your control, because once you decided that I want a short repayment schedule, then the payment balloons every month and there's a lot of stress on you. So that's my advice. Yeah. So net profit in this case is 2005 per year. So the final part is recycle, and look at that. Whew. You start owning portfolio of properties. Here's how, right? This is a little bit of secret again that I show you, that the course will teach you, right? In this case, money left behind is only 12,500 because you took a mortgage of 262,500 against your total cost of 275,000. Your return on cash is the net profit on rental divided by the amount of cash left behind, which is 16%. Cash returned from mortgage is 262,500. So what do you do with the cash? On to the next property, yes, and that's where you build your monopoly. You've got to get all your money out from mortgage. If you don't have mortgage, how are you going to get your money out? You're stuck for many years until you sell it, and then you take your money back, and then you buy the next one. You're never going to build this up. So the course will tell you how to gain financial freedom, and generally to own 10 properties in 10 years. I've done it, you can do it, and if you buy the right properties, they'll double every 10 years. After you have achieved 10 properties, I will show you several routes to go. You can either call your boss, tell your boss where to go, or continue in this property business full-time, or you can still do it part-time. Either way, you can choose a job that you're working for fun, and that is the best part, isn't it? So how to invest with what you have. The course will address this. Many students have this issue, especially when you're younger, that I do not have £100,000 or 180,000 at least to invest, so I can only invest in stocks. Well, the course teaches you the options to do it, how to form a joint venture, how to earn sweat equity after you've gained a lot of knowledge, to lead a JV structure, how to structure your holdings, whether you put it in the limited company or personal name, and then the tax strategies. Fundamental analysis. The course finally will teach you the numbers, and it will teach you the return on investment, the return on equity, what are the valuation approaches to real estate. There's generally 3 approaches, but there's more. Cost approach, income, sales comparables, calculating the internal rate of return. Now, IRR is used by institutions, by professional real estate investors, REITs, private equity. The difference between IRR and other amateur investors is that they just look at yields. Amateur investors just look at current yields. So the higher the cash flow, the better it is. So if you just look at this year's yield without projecting the income forward, you're going to end up with the cheapest properties with the highest rental income. But you know that rental income doesn't make you rich. It just sustains you. It gives you a slight income. In this case, in the previous case I showed you in the example, it's just 2,005 per year. It doesn't make you rich. It's a capital gains after 10 years that when you start to sell some of your property portfolio, it makes you millions. So if you use the IRR returns calculation, you are able to project the capital gains, you're able to project the rental returns, how much leverage you're going to take, what's the safe leverage, you can stress test it. So IRR is a lot better than the standard yield, cash flow, static cash flow methods that you use. So the course will teach you how to predict capital growth, and that is that demand supply dynamics. So if you're interested in the property value investing course, click on the link below and you can access the Piranha Profits page where you sign up for the course. After the course, you'll be put into a Discord chat group where I'll continue to address your queries. There will be periodically webinars as well, and then we can guide you along the way to, whatever questions that you have. Titanium Synergy is a joint venture between Josh and myself. Josh is in UK. He can specifically help you to find properties in UK, to mentor you, and to build a property portfolio which is 10 in 10 in UK. So I hope to see you there, and if you like and find my video useful, please like and subscribe to it. Thank you.